Ready to elevate your credit understanding and score? With insider tips and a plan, you can take action to improving your score, which can save thousands in unnecessary finance charges. Let's tackle today's topic with your coach, Credit Christy.
Hey friends, it's Christy, your credit coach. Thank you so much for joining me for another episode. I talk to so many people that just don't know where to start when it comes to starting with building a credit profile or on a mission to repair a damaged credit profile. But what I want to start off saying is you have to have a great credit profile. That does not mean you have to go into debt to do so. So what is a credit profile? It is a snapshot in time of your ability to borrow money and pay it back on time. It's as simple as that. But unfortunately, we're not taught the rules of the game. So how could you possibly win a game in which the rules have never been shared with you? You can't. You're set up for failure. So that's what we're going to tackle today. So let's dive in. What's most important to have reporting on your credit profile? You'll want to have at least one installment loan and at least 1 to 2 revolving accounts. So first off, let me define for you what that is. An installment loan is a car loan, a student loan, a personal loan, and in theory, a mortgage because it has a set dollar amount that's borrowed over a set period of time with a set monthly payment. However, mortgages actually show up in their own category. Although it is an installment loan, it shows up in its own category on your credit report, and a mortgage being paid on time is the most beautiful gift you could give to your credit profile. When it comes to revolving accounts, 2 main examples are home equity lines of credit, also known as HELOCs, and credit cards. So a couple of rules to know about. Having 20 credit cards on your credit profile is not always a good thing to help. It doesn't always improve your credit score. And quite honestly, you could look like a credit risk with having so many trade lines outstanding. Even if they're at a zero balance today, you could have at your disposal thousands and thousands of dollars worth that you could go and charge against those credit cards. I've also read reports that people who have greater than 6 credit cards with balances that they carry forward each month, in other words, they're not in a position or choose not to pay those credit cards off in full every month, they have 30 times larger potential of claiming bankruptcy than somebody who doesn't carry that much debt. So the purpose of having this credit profile is to have something to demonstrate to those that are making decisions about extending you credit in the future. So when you go to apply for a car loan, a mortgage loan, or a personally backed business loan, you want to show up as glorious as possible. So having a nice credit mix is going to help with that. Your payment history makes up 35% of your overall credit score algorithm. So make sure every single month you are making those payments on time. Now, length of history is also very important. I've heard people in the past say, I've had credit for 30 years. Well, that might be true, but if everything you have currently open and outstanding is only a few years old, that's really what the information is based off of, what is open and current at this current moment. Side note, if you have collections and late payments in the past, that also goes into the overall credit score algorithm. But basically, when they're focused on that payment history and that length of credit history, it's referring to the things that are open and active right now. Okay, so we've conquered mix and we've conquered length. Let's dive a little bit more into this payment history. So I've seen people's credit scores drop 75 points because they had one late payment. If you have a really high score, the higher you are, the harder you fall. If you've got a bruised or lower credit score and you have a new late payment show up, it may not hit you for 75 points, but you have less to go down. If you're in the low 600s and now you're in the high 500s, it's like jumping out of a window rather than jumping off of the roof. Either way, it could hurt. Now, when it comes to payment history, the longer you have something that's open and active and reporting payments, the better. So let's say you just got a new car loan. You'll have a new inquiry and you'll have a brand new trade line added to your credit. Initially, it could potentially hurt your credit score at the very start. But once you hit 12 months worth of payments And in some cases, 6 months, but really 12 months is like that threshold where your credit score could really improve because of now reflecting 12 months of positive on-time payment history for that trade line. Let's talk now for a moment about debt utilization. The utilization factor is mostly prominent when it comes to credit cards or your home equity line of credit, those revolving trade lines. Utilization is based off of your limit or your amount allotted to you to borrow versus how much you do have outstanding. Let's say you're in the process of rebuilding your credit and you went and got a secured credit card. So you're starting off with a $300 balance. I've seen some people max that baby out and then pay it off at the end of the month. But at the time that it's reported to the credit reporting bureaus, it is appearing maxed out. That's actually going to hurt you more than it will help you. And it's because of that debt utilization. At that point, when it's maxed out, you're at 100%. The credit bureaus really want you to be at 30% or below. And if you really want to knock it out of the park, then aim for less than 10% utilization. So if you have a $1,000 limit on your credit card, try to keep less than $300 balance. Or if you want that A++, keep it under $100 balance. So in that case, buy your gas, your groceries, pay your utility bill, whatever you use that for, and then pay it off as quickly as you can during that grace period. So let's talk about that. Credit cards have a grace period. It's typically 25 days, and you could call your credit card company and ask them, what is your grace period? They should be able to tell you roughly the dates in the month that falls in. And during those 25 days of grace period, if you were to pay off your balance in full, then you will not accumulate any interest. So you could literally have a 0% credit card. Now, if you wait until your bill comes due, now you're paying interest based off of that credit card's APR. And if you wait until that time to pay your bill, it's likely that they are reporting that outstanding balance that you're carrying to the credit reporting bureaus as your current balance. If it's greater than 30% of your limit, in that case, it could hurt your credit score. Now, when it comes to installment loans, it doesn't have that same utilization factor. That's really where we focus on on-time payments and length of credit history with that trade line. Again, older than 12 months, even better on your credit score. So let's talk about collections and charge-offs. Those fall under a different category on your credit report known as derogatories, and a new collection could really devastate your score. Now, there's a newer rule that went into play regarding how medical debts can be reported. If your outstanding medical debt is less than $500, it can no longer get reported to your credit report. So that's exceptional news. I can't tell you how many little itty bitty medical collections I would see on people's credit report. And why is it such great news? Because when it comes to collections, that derogatory listing doesn't really experience any difference whether it was a $200 collection or a $20,000 collection. A collection is a collection. There is a difference though as an open and unpaid collection versus a paid and closed collection. So if you are able to pay it and get it closed, that will be better for your overall credit profile than having an open collection. The only time that's not a good recommendation is if it's an old collection. There's something reporting on that account that's called a date of last activity. And it's kind of like scraping open an almost healed wound. If it's older, maybe just let it lie. Let it go away. After 7 years from it becoming a new collection, it will eventually drop off of your credit report. But if it's newer, then it is negatively impacting your score. And if you can get it gone, do so. Now, the creditors have a responsibility to the credit reporting bureaus to report accurate information if they are reporting it to the bureaus. So in many cases, you can ask to have it removed, but if it really truly was your collection and they can prove your collection and you've paid it, they likely won't remove it, but they will update the language to say paid and settled. Let me give you a quick example of somebody we just served this week. She came to us with mid 500s. She had lots of outstanding collections and unfortunately some late payments last year. We can't do much to change those late payments because they were legitimately late. But now that it's older than a year, it's not hurting her as bad because now she's had 12 months of on-time payments. What she can't control are those collections and charge-offs. So we went through her list and we found the ones that would have the biggest impact to pay off. And in many cases, she settled and it reported it as settled and closed. And even though they're still reporting, just changing it as having a zero balance instead of an outstanding balance and having it closed instead of open, that got her over the threshold of what we needed. So there was a combination of things going on. She paid down her credit card balances below 30%, and then she settled and paid a handful of collections and charge-offs. And I'm thrilled to share with you that her middle credit score, there's 3 credit reporting bureaus. When it comes time for a mortgage, we go by that middle credit score. And she now has a 651 credit score. Worthy of celebration, but here's what's most impactful for this client of ours. She can now qualify for the down payment assistance program that's going to give her over $10,000 towards her down payment and closing costs, which if she had under a 640, she would not qualify for. So we had so many reasons, not only just to help her with her credit scores, but the ultimate bigger goal of helping her buy her first home. So this is literally changing the trajectory of her life and maybe even future generations. Guys, it's that important. Okay, so older collections that haven't been touched for a long time, you might want to just let a dead horse be. When it comes to charge-offs, a lot of times you hear charge-off and you're like, oh, they wrote it off of their books, so that's actually better than a collection. Actually, charge-offs could be hurting your credit more than a collection account. If it's a revolving account, so in most cases credit cards, and it's a charge-off, it's a closed account, and it's a derogatory account. And so that means there's this zero limit and this now negative balance. So let's say you had a credit card, you had a $500 charge off. Now it's going to reflect zero limit, $500 charge off, and that means you're in the red $500. So it goes against your overall utilization factor, and that's where it hurts as a double whammy. So not only is it a derogatory account just like a collection is, but now it negatively affects your debt utilization. So a lot of times paying off charge-offs are better for your credit profile than paying off collections. But again, it needs to be newer. Now, before we get off of this category of collections and charge-offs, let me shift over to the mortgage side, because if you're working on improving your credit to get qualified for a mortgage, there's a few things that you need to know. The outstanding balance on a charge-off really isn't considered for mortgage approval, but outstanding balances for collections could be. So if you have an outstanding collection greater than $2,000, whether it's that one trade line of that collection, or if multiple collections exceed $2,000, then some loan programs require it to be paid off in full. So that's one of the things that I'll look at when I'm analyzing somebody's credit report. Let's say Jessica has 3 outstanding collections. One is $500, one is $1,000, and the other one is $600. I would have her pay off, if the age were all about the same, I would have her pay off that $500 collection. So that way the total amount is less than $2,000. Then we don't have to pay off those other 2. And if you have disputes on collections and charge-offs, that dispute language has to be removed prior to loan approval for a mortgage. So how does a dispute work when it comes time for your credit scores? When you dispute something, it basically hides that collection or that charge-off from your overall credit scores. So a lot of times when people go to credit repair companies, and they dispute collections and charge-offs for you, you might see your credit score soar, but it's false and it's temporary. So the creditors have up to 30 days to investigate, review, and respond to your dispute. Let's say you're disputing a particular collection and this creditor is able to prove, yeah, in fact, that is your account and it legitimately is your collection. They'll report that information to the credit reporting bureaus and then they'll say, yeah, this is a true collection. And if you disagree with it, they'll list it as dispute resolved, customer disagrees. But after that 30 days, it typically goes back to what your credit score was because they're not removing, updating, or changing that collection. However, that language has to be removed for loan approval. So let's shift over to co-signing. How does co-signing affect your credit report? If you co-sign for a loan, it's going to report on your credit report. If the person you have co-signed for makes late payments or stops making payments, you are now the responsible party. All the while, you have late payments and potentially now a collection being reported to your credit report. The only way to remove yourself off of a loan that you have co-signed for is to have that loan paid off. So it's a dangerous and slippery slope. Please use a ton of discernment and a lot of caution if you are going to consider co-signing for somebody. So a real quick recap, because I've talked about this in some recent episodes. How do you build credit without going into debt? You can become an authorized user on somebody else's credit card, and it will report as if it's your credit card, but you're not on the hook for it. And if they've had it for years and years, you will now have years and years of credit history reporting. Parents, this is a great way to help your kids build a great credit profile without going into debt. There are also some credit builder accounts out there. I know my local community bank offers it, and also Self.Inc. And this credit builder is basically taking your money from one account and moving it into another, but it's reporting as an installment loan. Think of it as a forced savings account for yourself to help you build up a credit profile. Please be careful with those buy now, pay later, where it gives you, say, 90 days, same as cash. If you are late on that payment, they will throw so many fees and interest your way that the cost of buying that one thing could really make it not worth it. And if you are late, now you have late payments showing up on your credit report when your only goal was to build credit, because it does report. But those little short-term loans could be more of a headache than a helper. So why is it important to have a great credit profile? The big and obvious is for loan approval. If you go to apply to buy a car or a home, not only could it be the difference of being approved or not, but your credit score is going to have an incredible impact on the interest rate that you qualify for. The higher you pay in interest, the higher your payment is, the less money you have to save, to put forward towards retirement accounts, to have fun with, to pay for your kids' college education, whatever your bigger, longer-term goals are. It all has an impact. A lot of employers will look at your credit report. Insurance pulls credit. So if you have a lousy or low credit score, you might pay more for your car insurance or your homeowner's insurance. Or you may not qualify with that carrier at all and have to go to a secondary type of insurance carrier, which would likely cost more. I did a quick search for different utility companies around the state I live in, which is Florida. And when I was poking around there, I learned that your deposit when you start new service is based off of your credit score. Obviously, and again, the lower your score, the higher that amount is. And one of the companies had even stated that if you didn't have any credit scores, they would not extend utility service to you. You have to have a cosigner that has a credit profile, and then they'll base that deposit off of that cosigner's credit score. All right, friends, so now I hope you feel equipped to truly understand the rules of this credit game. There are some quote-unquote gurus out there that state you don't need to have a credit profile, and unfortunately, that is just not true. I think a better, more important statement is you don't have to go into debt to have a credit profile, but it really is important to build, maintain, and protect your credit profile. If something terrible happens, you lose your job, you experience an illness, some unexpected or unforeseen event happens in your life, and you find you're not going to have the ability to make your payments, please, for all things good and right, communicate with your creditor. Let them know your situation. Say, listen, it's not a mismanagement of funds. I legit lost my job. I'm applying for new ones, but I don't have anything yet. And because of that communication, a lot of times they will give you a period of time of forbearance. In other words, they'll allow you to skip a certain amount of months of payments without it being reported as late to your credit profile. It's the most beautiful gift you can give to yourself when it comes to protecting your credit profile, is being in communication with your creditors. Make sure you have all the push notifications and emails set up with your creditors so that way when a payment comes due, you're notified. Perhaps you can put on your calendar, pay Capital One bill every 18th of the month, which is say 5 or 10 days prior to your due date. Set up some kind of your own game so that you're not missing any payments. And if you have things set up on auto payment, make sure if anything changes in your life that you update that information. Unfortunately, I've seen late payments hit people's credit profile because they had that automated payment set up on their debit card. Their debit card was lost or jeopardized or expired, and they didn't update that information with that creditor. And now 1, 2, 3 months goes by before they realize, oh my gosh, I haven't been paying that bill. And last thought I have on this is Credit Karma is not a credit protection or credit alert system, but since it is free, it never hurts to have an account set up with them because it will notify you once a month if your scores are going up or down, if something is different on your profile. It actually notifies me if I apply for credit. So just having those little push notifications or emails come in helps me to stay on top of my credit profile. Just be careful when you go into Credit Karma. They are in the business of pushing credit cards on you. So they're going to say, hey, you could qualify for this such and such credit cards that has all of these awards. There's a really good likelihood you'll get approved for this. Just don't give in to the temptation. Okay, and this is really my last thought, I swear. Do all that you can to get out of credit card debt. Pay that baby off. Go get a side hustle, a second job, work overtime. Ask for that promotion. Sell something. Get out from underneath this 20-something APR credit card debt. You guys, things are going to get worse before they get better, and you do not want to be a slave to debt. You cannot be the master of your money if you're just servicing debt payments. So get out from underneath it and do whatever it takes to make that happen. And when you pay that debt off, do not close those accounts. When you close those accounts, they're no longer added into your utilization factor. So keep them open with a zero balance. But again, just stay away from that temptation. I see too many people using credit cards and personal loans as an extension to their income. And if that's you, be honest, create for yourself a budget and then follow that budget. It doesn't have to be forever, but it should be followed until at least you get out of debt. And if you find yourself getting right back into those behaviors, actions, and habits that got you into debt, then you need to follow a budget every single month, and that's okay. Consider yourself as the CFO of your own life, your chief financial officer. If you were a business, would you just run your business off the seat of your pants, or would you know what money is coming in and what money is going out so that you can stay in business? Of course you would. So be in charge, be the master of your money. It's empowering, and you can set it up as your own game to win. Hey, if we haven't connected on social media, reach out. You can find me at Credit Christy on Instagram, TikTok, Facebook, LinkedIn, and YouTube. And if you have questions, feel free to email me at questions@creditchristy.com. Also, check out my books on Amazon. Finish Financially Free. It's my second book I wrote, and it's available on Kindle, print, or audio. Thanks so much for joining me, and until next time, my friends, stay well.